Welcome to Iron Financial, where we stress test company structures to see if they can actually support your portfolio. Today, we are putting Oscar Health, ticker OSCR, right under the microscope. And talk about timing. They just dropped an earnings report that's giving investors some serious whiplash. So the question is really simple. Is this a solid foundation for growth, or are we looking at a structure that's about to collapse under its own weight?
I mean, this is the conflict right at the very heart of Oscar, and you can see it laid out perfectly right here. On one hand, you've got absolutely explosive, record-setting membership growth. They are just pulling in customers like crazy, boasting 3.4 million enrolled members as of February 1st. You can't deny that's a powerful engine for top-line expansion and, market share dominance. Yeah, a powerful engine, but on the other hand, you have a nearly $500 million net loss for 2025. You just can't build a skyscraper on a sinkhole, so we're here to find out which one of these numbers really defines the company's structural integrity. This isn't just about red ink versus black ink. It's about whether all that growth is strong enough to patch a massive, massive hole in the foundation.
Okay, let's dive right into this. Here's our blueprint for today's analysis. We're going to start by examining the stress points in their current structure. Then we'll deconstruct the damage from 2025, piece by painful piece. And then we'll let them make their bull case with this so-called 2026 comeback plan. After that, we apply some real-world pressure with Wall Street's own stress test, looking at what the pros and, more importantly, the insiders are doing before we deliver our final verdict. So let's get to it. All right, Section 1. Let's get into the 2025 damage report. Before we even think about looking at any new blueprints, we really need to survey the wreckage from last year. And believe me, we are not looking for cosmetic issues here. We are looking for deep foundational flaws.
Okay, let's not mince words. This right here is the headline number that should make any investor just stop and take a deep breath. A net loss of over $443 million. This is not a small fissure. This is a massive, gaping hole in the balance sheet. And to put this in perspective for you, this is a complete 180 from 2024, when they actually posted a net income of over $25 million. That is a nearly $500 million negative swing in just 1 year. You cannot just sweep a number like that under the rug. And a key driver of that loss is this number right here, their medical loss ratio, or MLR, which jumped to 87.4% for the full year. Now, for context, that's up a staggering 570 basis points from 81.7% in the prior year. This metric, it tells us how much of every single premium dollar is being spent on actual medical care. Let me translate that for you. For every single dollar they collected in premiums, they're spending almost 88 cents on medical claims. The margins are getting absolutely crushed. And if you think that full year number is bad, the fourth quarter number was a jaw-dropping 95.4%. I mean, at that rate, you're not running a business, you're running a charity. That is a completely unsustainable structure, period.
And right here, this is the specific wrecking ball that smashed their fourth quarter and just blew up the full year results. A massive $275 million risk adjustment true-up. A charge so large it single-handedly explains the massive earnings miss. This wasn't just, a cost overrun. This was a catastrophic miscalculation. Okay, hold on, let's break that down because this is absolutely critical. A lot of people hear risk adjustment and their eyes just glaze over, but it's a critical support beam in the entire ACA insurance structure. We have to make sure everyone understands what just broke because this right here is the root cause of the 2025 collapse.
Okay, in plain English, the whole system is designed so insurers don't just chase after young, healthy, profitable people and leave the sick folks with no options. So if your pool of members is, on average, healthier than everyone else's, you have to pay into a central pool. If your members are sicker, you get a payout from that pool. It's meant to be a balancing act. Exactly. And the crucial point here is that Oscar's rapidly growing membership base, all those new people they signed up, well, they turned out to be significantly healthier than the rest of the market in 2025. You could say, ironically, they were too successful at attracting a low-risk population. And the result? They got slapped with that massive, unexpected bill of $275 million to pay out to their competitors. Their own growth became their biggest liability.
Okay, so the damage from 2025 is crystal clear. Now for Section 2, the 2026 comeback plan. Management is calling 2025 a reset year, and they're claiming that they've engineered a path back to solid ground. That's a pretty bold claim. Let's see if this new blueprint can actually hold up to some real scrutiny.
So let's start with the top line, because honestly, it's impossible to ignore. They are guiding for revenue somewhere between $18.7 and $19 billion for 2026. At the midpoint, that is a massive 61% year-over-year growth from the $11.7 billion they did in 2025. Look, this isn't just a minor repair job. They're planning to build a whole new skyscraper on top of the old foundation. That kind of growth, it absolutely demands our attention.
And this revenue growth is built on an absolute surge of new members. They expect to start the second quarter with 3 million paid members, which is a 58% jump from the year before. They are not just growing, they are dominating. I mean, their market share across their footprint has just exploded, jumping from 17% in 2025 to a projected 30% in 2026. They are aggressively taking ground while their competitors seem to be retreating.
And here is the projected payoff. This is probably the most important number in their entire forecast. They are guiding for a monumental swing back to profitability, with operating earnings projected to be between $250 and $450 million. Now, if they hit the midpoint of that, that's a nearly $750 million year-over-year improvement from the operating loss in 2025. That is not just patching cracks, that is recasting the entire financial foundation of the company.
Now, what's really, really interesting about this slide is when you put it all side by side. Look at the operating leverage they're projecting. A 61% revenue increase is supposed to cause a massive 450 basis point improvement in their medical loss ratio, and that $750 million swing in operating earnings. It just shows you how powerful scale can be in the insurance business. Well, the numbers look perfect on paper, don't they? A flawless blueprint. But it all hinges on them correctly predicting that risk adjustment this time around. They say they're baking in a higher number for 2026, but the question remains, after getting it so catastrophically wrong last year, are they being realistic this time or just dangerously optimistic?
Part of their comeback strategy is this pretty dramatic and very deliberate shift in their membership mix. So as the enhanced ACA subsidies expired, they proactively created these new affordable bronze and gold offerings. And the results are just stark. Silver plans dropped from 71% of the mix to just 36%, while bronze and gold plans just exploded. This was not an accident. This was deliberate financial engineering. But that engineering, it comes with a lot of risk. Shifting people into higher deductible bronze plans, that's a double-edged sword. Sure, it keeps them on the books for now, but what happens when those members start seeing these massive out-of-pocket costs for the very first time? Are they going to stick around? That potential for high churn could destabilize the very structure they're trying so hard to build.
So that's their pristine blueprint for 2026. Looks good on paper, but a blueprint is totally useless if it can't withstand real-world conditions. So welcome to Section 3, Wall Street Stress Test. Let's see what happens when we apply a little pressure from the analysts and, the insiders themselves.
You know, the analyst community is clearly very cautious here. The consensus rating, according to MarketBeat, is reduce. Out of 10 analysts that cover this stock, only a single one has a buy rating on it. The vast majority are just sitting on the sidelines. Exactly. 7 are on the fence with a hold, which is basically them saying, show me the money, and 2 are actively waving red flags with a sell rating. This is not a vote of confidence. This is the market of professional architects looking at the plans and saying they're not convinced the structure is sound.
And it's not just the average rating either. We've seen specific, very recent downgrades that should concern any potential investor. You've got Wells Fargo cutting their price target. You've got Wall Street Zen going from a hold straight to a sell. These are the inspectors looking at the blueprint and saying it's fundamentally flawed.
Okay, we have to address the insider selling because it's a critical data point we can't ignore. There have been consistent sales totaling over $3.2 million in just the last 3 months, including sales from insiders Janet Liang and Adam McCanney. We have to think about what this signals. It's really more than just a data point. It's a warning flare. I mean, when the people inside the building, the ones with the most intimate knowledge of the project, are selling their shares, it raises some very serious questions. What do they see that we don't? It weakens the entire case for the foundation's strength, and it suggests their confidence doesn't quite match their public guidance.
All right, we have surveyed the damage from 2025, and we have reviewed the very ambitious blueprint for 2026. We've applied the stress tests from Wall Street and from the company's own insiders. So it is time for the final verdict. So what's the call? Is this an opportunity to build a position, or is this just a structural trap designed to lure in unsuspecting capital? Look, the bear case is clear, and frankly, it's compelling. The company is bleeding cash, its core profitability metric is dangerously high, and it's exposed to the massive, unpredictable variable of risk adjustment. You've got Wall Street nervous, and you have insiders selling. It looks like a classic value trap, one that's built on the hype of growth but without a solid foundation to stand on. But the bull case is all about the future, not the past. The argument is that 2025 was a painful but necessary reset year. The growth is undeniably powerful. The guidance? It presents a clear, data-backed path to a profitable structure. They've addressed risk adjustment in their pricing, they've raised capital to fortify the balance sheet, and they've engineered a product mix to weather the storm. This looks like an opportunity to buy the foundation before the skyscraper is even built.
So our final verdict at Iron Financial is this. Oscar Health is a speculative build. The potential reward here is enormous if, and I want to stress, that is a very big if, they execute flawlessly on their 2026 blueprint. The turnaround story is compelling, the growth is a powerful force, and the market opportunity is significant. But the risk of collapse is very, very real. Execution has to be perfect. Any miscalculation in their MLR or another nasty surprise from that risk adjustment could bring the whole thing crashing down. This is not a stable blue-chip stock for your retirement account. This is a high-stakes construction project, and you are betting on the architects, the engineers, and the quality of their brand-new blueprint.
So we are going to leave you with this final thought. Management has laid out a very detailed blueprint for a massive structure. The potential is clearly there, you can see it in the numbers, but the ground it's being built on has proven to be incredibly unstable. And so the question you really have to ask yourself is, do you trust the engineers? Thanks for joining us at Iron Financial, where we help you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.